When do you think we're going to be reacting? Because this is my conundrum with all of this. All of this is hard to. There's a lot of kind of small bits, and then you don't know what the derivative effect of those small factors are going to be.
Yeah, I mean, I think there's going to be a phased reaction, and we certainly will get a reaction today, but whether you get a longer-term reaction really depends on what we actually get, which we don't know that much. In terms of what I'm watching, it's three things. It's how much fiscal headroom do you have? Yep. Is there credibility behind the budget? And what are the economic implications? In terms of the fiscal headroom, it's pretty simple. We got 10 billion last time. We want more than that now. Yep. Somewhere closer to 15 to 20 would be quite positive, I think, for both the pound and gilts through the risk premium.
What's priced? Is 15 priced?
I think this is quite a hard thing. I think particularly with the pound, there's a lot of pessimism priced. So all the talk around the budget so far has been Reeves has this tightrope she has to walk where growth is either going to get much worse or she's not going to have fiscal credibility, and both options are negative for the pound. I think in reality, markets are forward-looking. So we've had a reevaluation already of 2026 growth prospects in the UK, and that's found into negativity in the pound. Certainly, if you look at Euro GBP, you can say that there's some kind of risk premium price. It's very expensive relative to interest rate differentials. You're also at a level that's kind of comparable with the Liz Truss crisis. And I think we shouldn't be, comparing this fiscal scenario to that scenario. So if we move past this kind of fiscal scarring that I think actually stemmed from the Liz Truss crisis and just hasn't gone away, and we move past the uncertainty, then you can certainly get a relief rally in the pound.
Yeah, I mean, it's a nice risk-on day to do anything, isn't it? I mean, due to things that nothing to do with the UK, due to expectations of a Fed rate cut, Skylar. How has your thinking around a rate cut been shifting based on the weakness in the data that we've seen in the United States?
Yeah, I mean, we haven't actually gotten that much substantial in the last week, and it's been funny how we've had this big turn, because I think you should probably take more signal from Powell than from the Fed figures that we've had in the last week that have shifted things more dovishly. And I haven't seen anything super concrete in the data that makes me think that a December cut is absolutely certain. So I think because we've now moved to the other end of the scale, the risk is very much that, you don't get that cut, or that cut doesn't, become as certain as you get more data come in, as you get closer to the event, as, we enter the blackout period and people are more uncertain. And maybe the surprise comes on the actual December meeting. But I think we're still going to be in this choppy environment, and it's not necessarily a straight line where dovish bets mean that the equity market goes up.
Skylar, very quickly, I'm putting you on the spot here. And just talking about how jittery these markets are, whether it comes to the UK or to the Fed, we're talking about this 15 billion pound figure. If the market comes in, or if the budget comes in less than 15, how violent is the bond market reaction, and is that contagious to the rest of the world?
Yeah, I mean, it's interesting because what you've seen is that government bond correlations have actually come down as you've had deglobalization, more realization, and risk premium elsewhere. But I think certainly there is a feed through, and the feed through is more to those countries that are kind of fiscal misbehaviors. So it's your Japan, it's your France. That's where you can see more of that tailwind because people think about risk premium again and they go, well, maybe I need to price it here.